So it comes down to, I think part of the story is that because expectations were set low and now earnings are coming in and people are increasing their expectations, that is why the market has become really just this one-sided rally. Is it because people are playing catch up because people had expectations too low and now so it's sort of chase just to get in because I have to be in?
Yeah, well, in part, I mean, that said, if you just look at S&P 500 earnings over the last 6 quarters, 6 or 8 quarters, like you're certainly not seeing double-digit earnings growth over the last 6 or 8 quarters on the S&P 500, right? Like, if anything, actual earnings, have been pretty mediocre over the last year and a half or so. And so, I think what's happening is that people are extrapolating um, that the economy is not going to be terribly weak. There's a lot of concern about the economy being terribly weak, resetting their expectations to being strong and extrapolating growth that's happened that's price growth, like positive, strong returns that has predominantly come from not from earnings growth, but from resetting multiples. Multiples going higher, and they're then extrapolating that into saying, well, because those multiples essentially have gone higher, then what we're now going to see is we're actually going to see the earnings that match the multiples that we're seeing. And of course, there's certain companies where that's happened, like, Nvidia has actually gotten at least reported earnings that are not that far off of what those multiples were in terms of in terms of what's going on. But that's few and far between. In aggregate, the S&P 500, the earnings growth situation is basically flat for the last 18 months, and multiples have been driving the expansion. And now people are saying that it's going to be earnings in the future. It's pretty hard to see from a macro perspective how it adds up.
So does it worry you that the market is being led by just a handful of stocks?
Well, I think from a macro perspective, as a macro investor, essentially there's always winners and losers in a stock market, and so I think you get caught up in, oh, is this just a Nvidia story or just a this story or just a that story? Like, when it comes to an equity market, there's always going to be people on the right side of the tail, left side of the tail. That's the way it works. It is more concentrated, in terms of market cap and things like that than it has been in the past. And so you essentially, when you're thinking about those earnings expectations, there is more concentration to a smaller number of companies to continue to deliver those earnings. But the reality is that what's expected is in part going to come from those sort of high flying stocks, but also a big chunk of it, more than half of it, is expected to come from the S&P 493. So the rest of the market has to deliver in terms of the real earnings outcomes in order to justify the continued appreciation of these companies. And so I think one of the things that's interesting in the market right now is you're seeing a lot of people say, well, stock prices are justified because earnings expectations are rising, right? That they're pointing to those earnings expectations as justification for the current price level, but the earnings expectations haven't been delivered. They're not pointing to earnings as the thing that's driving the price increase. They're pointing to earnings expectations as justifying what's going on. And those two things are very, very different story. If we have a continuation, if we have 5% earnings growth over the next 24 months, that'll underperform what bottoms up analyst expectations are by 20%. Right. So that's a pretty big difference in terms of that. So there's a lot of betting that that those earnings are going to get delivered the way that they're currently priced in or expected.